In this video, guys, let's talk about should you be smashing the market in these current conditions. Stay tuned. Hey traders, warm welcome to you. All right, so a big question that always gets asked by kind of newer traders is, hey, market's absolutely wild now. Should I be absolutely smashing it? Should I be making money? And listen, my answer is the honest answer based on 2 decades of experience in the market. And it's an answer from a personal perspective. I can't speak for others. I know plenty of other traders. I'll give you their approach in a moment. But my answer to this is no. My answer is, if the volatility is so high that you feel seduced by it, that's already a red flag. Now, let me measure that and say, hey, the good thing about volatility is opportunity. The good thing is you can take an opportunity, you know there's going to be plenty of opportunity. So the approach to take isn't smashing it as in bang, bang, taking all this and trying to take all these trades. It's saying, hey, we've been blessed with volatility. That yields opportunity. Let me now be very, very careful about how I'm going to trade, the trades that I really want, the patterns that I really want to take, and wait for those. That's my approach. Guys, I've traded almost lighter in terms of frequency recently than I've done months before, because the opportunity is there. I know that if I get on the end of a trade, it's a 10R. So I'm waiting. I know what I'm looking for. I know the type of trade I want. I know the conditions that it warrants. I know all the metrics that I'm looking for, and I wait. And that might mean not doing anything for a day, day and a half. It might mean having a nibble with a small size, getting stopped. It might mean scaling up to a position and taking some. It might mean, still keeping my hand in and trading, some of the things that I see. But in terms of smashing it, that comes waiting for the opportunity that you want. Waiting for the exact moment you want. And that might be, let me give you some examples. Let's just talk examples here. And again, no recommendations, all that type of stuff. But that might be, hey, market's down heavy on the day and some news comes out that says Russia's pulled out or whatever the good news is, market just rips. That might be, again, keep the risk management and all the other stuff. That might be something where you go, if I see that and I'm involved in it, I will go in heavy and I will risk more than I normally would, and I will get this stock, or this asset, this currency, whatever. The point is have it planned. Have it planned. So we don't go in and we're smashing just this right and center. We're going, okay, this could give a big opportunity for me. How do I want to approach it? Well, if X and Y happens, I'm immediately going to buy this. Or if X and Y happens, I'm selling this, I'm doing that. Now, you're not saying it's going to happen, but by being prepared, and let's say that example, let's just kind of imagine it. And we had similar a couple of weeks ago. I shared this trade actually. I think we started to see that we gapped down. I think it was the 3rd day on the down day, or 4th day gap, flush lower, real heavy day. It was already oversold, massive oversold readings on all the indices, and then we started to rip. I was like, I already knew the stocks I was going to buy. I went for 3 stocks, bang, 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 bought the stocks, and I had a plan for holding them, and I'm not going to bore you with the kind of full details of it. The point is I was ready for that opportunity. The opportunity arose. I put some chips on the table, played out very, very well. Took the money off the table. One of them was exceptional. I had to adjust the plan. That was what we were talking about, adjusting the plan actually. Took the chips off the table with one, left the other 2 to follow through. They gave a little bit back, so it wasn't a perfect trade, but it was a great trade nevertheless. The point is being prepared to take advantage of some unusual setup is the way to trade this market. So what are the ways to trade? Now, I've kind of got off track a little bit, but stick with me because I think this is value to you. Imagine if the market's down heavy, it's been battered, and then we have some positive news out and we see buying, and we see that kind of straight up buying. You've got a gap fill there. That's generally going to be a target for the market. It's already deep discounted, and now we have good news in. I don't know what the good news could be, but imagine it for yourself. Then that might be right. Ooh, I'm going to go straight in. I'm going to maybe buy the indices, maybe buy stocks, maybe you sell gold if that's your watch, maybe you sell crude, or whatever the play is for you. But having that prepared and saying, if I see this, this and this, I'm going to short the hell out of crude, because I've been watching crude, I understand crude, and that's the thing that's going to take a hit. It's going to come back down. I think we're going to hit 90 bucks over the next few days, if so and so. So you start to formulate a plan. I'm not saying this is going to happen, but you start to formulate the plan. That's the beauty of the volatility. You don't get this opportunity when the market's quiet and sedate and ping-ponging back and forth, because you're planning for something that is probably got a 1% chance of happening. Some of that's happening is probably 10%. That's a good chance. There's a good chance that we could be in this situation, something comes out and changes the narrative. It's a headline-driven market with Russia and Ukraine. It was inflation before, now it's this. So you having a prepared plan. And imagine this is like how I like to imagine it is, you go into a meeting with your risk manager. You're like, come in. Right, Mr. Risk Manager, Mrs. Risk Manager, I'd like to take triple risk on a specific trade, or 5 times risk. So have a seat, sit down, tell me. And you say, right, Mr. Risk Manager, when this happens, and we have this, and we see this, I'd like to take risk on this, 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 and this, with this, this, and this trade, and it'll be 5 times the risk. What do you say? Yeah, if that happens, happy to you take 5 times the risk. Means you'll be out, if you do get stopped out, you'll be out for the month. Are you happy with that? Yeah, okay, I'll authorize that. So that's the kind of, I know it sounds crazy, but that's the kind of role play you have in your mind where, okay, your risk manager's authorized that you, or the risk manager and the trader, you're saying, yes, okay, it's fine. So that's one thing, and I went off on a bit of a tangent there because I think it's a value to you, and hopefully it is, having a plan. And that might not be that, by the way. It might be something different, like, hey, we're rallying and then we have bad news, or it might be something normally catalyst related to get that extreme supply-demand shift. But being prepared for it means that when you do see it, you're not chasing it, or you're not this, you're not that, you've got no plan of action, you're not, whoa, it's moving. Because the issue we have with this market conditions, guys, is it's volatile, and the amateur gets seduced by volatility. He gets seduced by the swings and says, I should be killing it in this volatility, and starts to get killed instead. Whereas the more seasoned amateur and the professional says, hey, I love this volatility. It's giving me chances to make significant returns on my money in terms of our multiples, just because of the nature of the beast. It's also giving me significant opportunity again and again and again. I'm not waiting for time and maybe days for a setup. There's going to be something that's happening. So it means you can be more picky. It means you can be more strategic about how you deploy your capital. It means you can be more fussy about when you get involved. So it doesn't mean smashing it. And listen, guys, that's me. I'm more strategic with it. I look for the higher R multiple returns, and I play that game, and I'm prepared to put more chips in when I see something that is exceptional. And that's just the way that I like to trade it, because I traded through many different markets like this, flash crash, crisis after crisis, this terrorist attacks, all this type of stuff. And wasn't as seasoned to some of those as I am now, but I've seen how these play out, and this is something that works for me. There may be other guys out there who really thrive on this volatility, really thrive and are very, very active, and it's making it work for them. I would say that's the lesser side. I don't think people's activity necessarily goes up. I just think, similar to how I operate, is that they know the good setups. They might be a little bit more frequent, like maybe they're day trading more actively some active stocks, or some active stuff that's in play, like energy and defense stocks and this type of stuff, and they're all right in with the thick of it, and they see some of these setups and they get them, press them a little bit harder. That's just a higher frequency version of the way that I like to operate. But I think the theme's the same, is that you have a plan, you could be now a bit more fussy and a bit more prepared, and then you operate under those conditions and say, hey, we're more likely to get this. These are the great setups I want to trade anyway, and this is the mega setup that I want to take if I see it. So being prepared for it. So it's a gift, guys, of volatility, but don't throw it away. Don't squander it by being seduced like a beginner trader and going, oh, flashing lights, lots of move, market's moving 700 points, Dow's moving 700 points, we're down 3% on this, crude oil's up this percent, blah, blah, blah. I need to get involved because I should be making loads of money. No. That's the amateur way of looking at it. It's the beginner way of looking at it. If you get sucked in and get chewed and get spat out. Why? Because the ranges are wider. Why? Because the volatility is wider, liquidity is less. All the things that you're used to and conditioned and been learning over the years getting chucked out the window. And you're wondering, scratching your head going, yeah, but that looks like an exhaustion. Yeah, but you're about 15 minutes too early, pal. It's not even got it started yet. This is different conditions, completely different conditions. So don't feel bad about that. But just say, hey, you know what? Just because it's moving actively doesn't mean I have to get involved every single move and see it. Whoa, I should have got this and got that and got the other. Step back. Take a step back. Be professional about it. Review it. Say, what would I like to see to get involved in this? What is the more frequent setup that I'd like to trade, perhaps intraday or every couple of days you're a swing trader? And what's that mega setup? If I saw it, I'm prepared to take a little bit more risk in. Think in that manner, and I believe that'll serve you better than getting seduced and sucked into just trade the volatility and say, I should be smashing it, I should be smashing it, I should be smashing it, and not considering that you're the one that might get smashed if you're not careful, because it's like surfing big waves, right? People surf in normal waves, but those big ones, those stupidly big ones they have in Portugal, where the guys like that big compared to the wave, you know, they're experts. They recognize they're waiting for the right conditions at the right time and the right this, and they know, hey, if I mess this up, I'm a dead duck. And it's a similar type of thing in the market, you know. It's actually been headline driven where it's gapping as well. One more thing, be careful. At the moment, it's a very headline driven market, and anything can come out and you can be on the wrong side of it. So if you're playing the game of getting involved in the market in the current conditions, just know this, that the risk is higher, but the potential reward is there. So we have got the potential for those 10-hour trades and more. Ridiculous numbers because they're adding scaling and really pressing the throttle, and great. But they accept the fact that they could get in at any moment, bang, headline comes out, thing just rips one way or the other. There's that overnight risk if you're taking overnight. So just be aware that with the added volatility comes the added risk. I know you know that. I know you've been around to understand that, but it's just worth mentioning. Anyway, take care. See you next one. Bye-bye.